I always say this. You never lose money on a bad stock. You lose money when you buy stock when you're calm and when you're trying to sell it when you're scared. And it's all about emotions. The investing decision should always be done in I'll say, thoughtful manner. And that's where you need to take out your emotions from your investing process.
Everybody says buy low and sell high. But what does buying the dip really mean? And is it really a good strategy to go all in when everyone else is pulling out from the market? Hi, I'm Suetan, and you're listening to Head Start on Record, a show that gives you a head start in your personal finance, career, and life. In the studio with me today are our market gurus, Arpit Agal from Syfe and Chong from PhillipCapital. Hi guys.
Hello.
It's so good to have you here today on the pod. And actually 2 episodes ago, I did an episode on investing in tech stocks and whether tech stocks are still a good investment. And then we know that last week, something happened, which is that there was quite a massive sell-off, right, on tech stocks. And that also led the market to dip. So in terms of that, in Chong, what happened there? Like, what happened to the market? And was that actually the time for me to go all in with my savings?
Okay, I think last week, the market will always have catalysts. So there are a few catalysts. It probably like AI companies. Some people feel that it's overvalued, so there's some profit taking. And also Iran, US war, maybe people feel that the war might not end so soon. And also the job market has reported robust, so means that rate cut might not be so early. So therefore, because of this, it might be a catalyst that caused the market to dip. And to answer your question whether to go all in, I think it depends on the investor, whether is that in their plan. But for me, my case, I wouldn't go all in. So they should always focus on their long-term plan, their goals, their risk asset allocation, so on and so forth.
Okay, so they shouldn't react like impulsively, right? Okay, because Arpit, I actually have heard people, I think last Monday, right, when it dipped and then even the STI opened and it was like lower and people were like, okay, now's the time. So what do you think?
No, I think that's a great point. And going back to Chong's point around staying invested in the market, what we saw last week was another example of a lot of news about geopolitical uncertainty, Iran war, some job report. And one thing, especially as a young investors, you need to realize there's always been noise in the market. As long as you are staying committed to your long-term plan, staying invested and letting the compounding do the work, you're good.
Okay, well, people always say buy the dip, right? Like, what does that mean actually?
Buying the dip is pretty old concept in a way. Warren Buffett was one of the initial, say, person who coined this term. And he was someone who will keep the cash and wait for the right opportunities to park that cash. But honestly, over time, it has been misused in a lot of places. When people talk about buying the dip, they end up confusing with, timing the markets and always hoping for a right entry point.
Okay.
Which to me is a bit difficult to replicate.
So what is the difference between what Warren Buffett says about, buying the dip versus, like, for example, young people saying that, oh, this is about timing the market, like I'm just keeping everything until the market dips and then I go in?
Okay, I think the difference is that Warren Buffett, he will assess the fundamental of the asset before going in. But because of the risk, all these years, all the events that leads to a market dip, investor always buy the dip, right? So it become an automatic response that when they buy a dip, it will definitely go up. So they didn't really go access the fundamental and they just buy it. So that's the difference, because Warren Buffett will actually assess the fundamentals.
Okay. So I guess one is like truly an expert, right? And then one is like an auto reaction.
Yep.
And also because of what everybody around you says. And also for the record, we are recording this on June 16, right? And markets have actually recovered, I would say. And they even enjoyed a rally earlier this week, right? Driven by news of like a peace deal between the US and Iran. And actually, when I checked earlier today, the STI was up like 3%. So, people would have said then, okay, if I bought last week during the dip, I would have already earned money in 1 week, right? What would you say to that though?
No, that's a great point. And we talked about that, staying invested in the long term. If you look at the historical data, if you are staying invested in the market, time in the market is always better than timing the market. A great data point is, if you look at the history of last 20 years, if you miss the best 10 days of the market, you end up losing 50% of your return.
Wow.
And if you end up missing 20 best days in the last 20 years, you almost will make nothing. So that's the thing about buying the dip and timing the market. You can never do it. You're always waiting for the right entry point or the best time to invest. The reality is, again, if you're invested staying in the long term, I think things will take care of itself.
Right, because you will never know, right? When were
Exactly.
the last
You can never
the
know.
10 best days.
If today is the day.
Yeah, okay. I mean, I'm sure Warren Buffett doesn't know either, right?
Yeah, definitely.
Yeah.
Yeah.
So speaking of market movements, right? I guess it's been quite a wild ride in the last 1.5 to 2 years that Donald Trump, since he started his second term in the White House, I mean, we've seen Liberation Day tariffs, we've seen the war in Iran, and then the oil shocks, the energy crisis, and then even most recently, a new chair, right, taking over for the Fed Reserve. So, in Chong, how has the market responded to these events actually?
Okay, I think the market respond to this event rather negatively. Means that the market dip because a lot of investor they are just trying to predict what is the market going to react to next. So I think it always depend on investor do they have a plan in place, or rather they are just listening to the noise that's created by such events.
So do you think this is why when there's bad news or uncertainty, immediately the market dips?
Yeah, as we discussed earlier, it's a great example of markets being moved by a lot of sentiments and less from fundamentals. So you'll see a lot of noise, a lot of market news, which is really influencing the market right now. But if you take a step back over a long term, generally market always moves upward. So that sometimes I think people miss in the short term.
Actually, interestingly, even in the last 2 years, right, even though so much has happened, but we would say the markets have dipped, but they haven't actually crashed, right?
Yep.
And the crash is nowhere near, for example, the financial crisis that, happened 20 years ago, 30 years ago. Do you think there's a reason for that?
If you think about it, maybe you can argue that the financial crisis of 2008 was still driven by fundamentals. There were some weaknesses in the financial system, and that obviously took over the entire markets.
Right.
But if you look at the recent examples, especially the last year or this year, most of it is still driven by sentiments and less by fundamental. So potentially I'll argue that, yeah, it's a different scenario this time around.
Okay, and actually, people have also said, young investors, they have not experienced the real crash, right? All they've seen are dips, and that is why maybe they are still thinking, oh, I can time the market, I can try to buy the dip. Do you think that's something that you see?
I think that because of the past event, every single time you buy a dip, then the market rise. It goes even higher. So it becomes an automatic response. But what's different now as compared to the past is that the market is rather different in terms of the inflation is still high, and the job market was interestingly still high as well.
Yeah.
So that's the reason why the Fed has not aggressively pulled down the interest rate. So of course we will never know what will happen to the market. So the best way is to really stay invested in the market and focus on their plan.
Actually, so when we talk about buying a dip, right, the assumption is that you are going in when everybody's going out, right? So is that something that investors or young investors actually typically do? Because isn't the main reaction that they all panic and then they pull out?
It depends on, there are a few types of investor. The first type of investor, if let's just say they are new to the market, probably they will just panic sell. Whenever they hear a noise, then they will just sell it. Then there's another type of investor, probably more seasoned, they've been through some dips and it become every single time they buy, they rise. So it depends on which type of investor they are in.
Okay. And do you see that as well?
No, I think that's a great point, and potentially I'll argue that anytime there is some big movement in the market, there's this category of people will go and do some panic selling. Oh, I don't want to hold on to this stock. And then there are people who will try to chase the next big thing.
Yeah.
Potentially, I'll argue that both of them are extremes and you should try to avoid as much as possible. And that's where having a long-term plan and, having a diversified way of investing really helps.
Okay, yeah, interesting, because you spoke about panic selling, right?
Yep,
I mean, do you have an example, maybe in recent years where that really happened, when everybody panic sold, or maybe last week even?
Okay, I think one of the most recent event is actually the Japan carry trade. So when the news is actually, the interest rate of Japan actually released the news, right? Then immediately the market actually just sold off. Yeah, that was one of the most recent sort of that is quite deep.
But I mean, what would you say to investors that will panic, and will sell?
Yeah, personally, I think that it's very important to have a plan. And ideally, the plan should be more long-term, especially if you're talking about younger investors. Once you have a plan, there are different ways to, execute that plan. One of them is potentially having a auto invest or a recurring investing, where you can do a dollar cost averaging, which means that you put aside some money every month or every week for investment, and then you stick to that for a period of, let's say, 10, 20, 30 years.
Wow, okay.
And then second is also finding the right instruments. So having potentially a broader exposure to the market always helps in some of those scenarios of panic selling. And if you are mature, if you are advanced enough, there are always this option and where you can hedge your portfolio. But yeah, I mean, going back to your point, and I can personally relate to those examples of going to the extreme. Either you are trying to chase the next big thing, or you are trying to sell everything that you hold on. When I started investing back in like 2011, and there was this popular stock called Zynga, which will make video games for Facebook. It was the in thing. Everyone was talking about that. It IPO'd at a very high price. Everyone was chasing that. But within few months, it went down, and now the company is taken over. But at the other extreme, 2022 is a great example. 2020 is a great example. During
Right.
COVID. A lot of people were really doing a panic selling
Yeah.
upfront. There was a big dip suddenly, and then people realized, okay, maybe there is not the right reason to sell right now. So yeah, I've been through the cycles, and I can now, looking back, say that yes, staying invested in the long term helps.
Yeah, I mean, you preempted my next question actually, which is about COVID, right? Because I think that is one point in recent memory where people really all pulled out of the market all almost at the same time because they were like, well, travel's down, nothing's moving, we can't do anything. And then if they had held on, right? Now it's
exactly.
like, how much has it gone up by?
Yep.
Yeah. I mean, in Chong, for yourself, like, how do you deal with that COVID situation?
For the COVID situation, what I did was because back then, maybe I share a personal story. When you all just share a personal story with, just now, it leads me to think back when I first started investing, right? I actually bought a stock. But that stock is just I hear from online.
Oh,
I hear
okay.
from online, then I just bought it. And you know what happened? After like maybe 1-2 weeks, suddenly the dropped 40%.
Whoa.
So immediately I did what most people do, like immediately I sold it. So that was my first time dabbling into the market and understanding what panic selling really is. But after going through that specific situation, and I really take a step back and to really look at fundamentally strong, for example, like funds like S&P 500.
Yes.
So over the long term, they actually go up. Then even every dip is a chance for you to buy. So during COVID time, because of this lesson, right, it makes me stay invested rather than just panic selling. Yeah, so for all the younger investor, whenever you are in doubt, try your best to actually look further, zoom out.
I think zoom out,
Zoom out
that's
is a
a
good-
great
yeah.
thing, right? Yeah, because sometimes you can just be so in your head with like the daily news and all that and what other people are doing. Okay, and I think you mentioned like funds, right? So
Yep.
actually during a dip, is it better to do individual stock picking or buy into funds?
I think it depends on the level of investor the person is in. Okay, when I just shared my personal story about I bought a stock and I dropped 40%, right? So at that point in time, I'm very new. So I do not know about the fundamental of the asset. So if you're new, it's always ideal to actually buy a fund rather than stock picking, because stock picking has more component that the average investor might not know of. And it can lead to the same situation. I mean, the moment I buy, suddenly it dropped 40%. And I do not know how I can react to it.
Okay. So actually, what is like the fundamental difference between, let's say, an ETF, an exchange traded fund compared to a single stock?
I think, you brought up a good point around exchange traded fund. What I've seen, especially in last 4 to 5 years, it is really gaining in popularity. Especially
okay.
if I talk about the younger investors. What we have seen on Syfe is every time there is a big volatility or there is a dip, the ETF volume goes up. If I talk about last quarter as an example, we saw a 50% jump in the ETF trading in this particular age group of 18 to 30. And for everyone, an ETF is essentially it's trading like a stock on an exchange, but then it gives you exposure to a set of diversified stocks. So it tries to replicate a index. Index can be an S&P, it can be Nasdaq, it can be Straits Times, and then it will then give you an exposure into a broader bucket of stocks. So you are more diversified and less, prone to market shocks.
Okay. So it makes you less vulnerable, right?
Yes.
As opposed to if you have one stock and then something happens
Yes.
to that sector or to that company and then immediately everything is wiped out.
Yes.
Okay. So that's actually really interesting, right? Because I think ETFs used to be seen as almost like conservative, right? When people thought stocks were really exciting and all that. But it's interesting to hear that now more people are interested in them because of the market volatility.
No, I think, and the good part about ETF is it's trading like a stock. So you can buy and sell it at any point of time. You can look at the prices and then you can make a decision, just like what you do with a stock. And at Syfe, what we have also seen is people are also going for, a broader basket of stocks. So even if they're not going for ADF, there's an option to, what we call internally as bundles. It allows a user to just take a position in multiple stocks in one go.
Okay.
So yes, more and more users are now trying to diversify and go for a broader set of positions.
Yeah, which is definitely a good thing, right?
Yes.
I mean, when we talk about like how the market, the dips and the troughs are kind of like deeper than previously. Actually, there's a question to in Chong, like how has the market changed from, let's say, 10 years ago, right? Because now we hear about how, the swings are so much greater, or maybe they're more frequent than they used to be, let's say, 10, 20 years ago. And the market that young investors are entering is now much more volatile or turbulent than it used to be. Is that true?
Yeah, I think the market has changed as compared to during COVID time. One of the reason is because of the fundamentals as well. So during COVID time, if I recall correctly, the inflation went down and the job market actually weakening as well. So therefore, the Fed can actually do the QE, quantitative easing, to actually drop the interest rate. But now the market is a little bit different because the inflation is still high and surprisingly the job market has continued to be growing as well. So the Fed cannot come in just lower the interest rate. So that's the difference in both market. And because of these two markets, the sentiment of the investor also changed. And because of now there's also geopolitical tension like the Iran and the US war. And I believe that because of this, the younger investor would actually be in a very different situation as compared to back then. Because of this, the sentiment as well, then the swing will be bigger as well.
Okay. And I think people have also said that now like algorithms play a larger role, right, in the market as opposed to previously when maybe it wasn't so high tech. Do you think that has also caused like greater volatility in that sense?
More and more people are now entering the market, which is good, obviously, in the long term. But then also there is a lot of, market noise and a lot of chatter about what's happening in the market, which can then end up confusing you in the short term. Yes.
Okay, and I think you guys have already mentioned, right, about, staying in the market instead of trying to time it and all that. I think you talked a bit about dollar cost averaging, right, to put in a certain amount every month, regardless of where the market is, so that you ensure you don't miss like the market's best days. Do you think that is something that all investors should do, or are there still some investors who are okay with like timing the market? Like, does it just depend on like their time frame and their goals?
That's a great point. And also, and again, maybe I can relate to my personal investing style. So I'm a long-term investor and I generally go for those boring and old school way of investing,
Okay.
which means just putting in a fixed amount every month in a diversified set of ETF. At the same time, I tend to keep 10 to 20% of cash buffer. If I see any opportunities or if I have any strong views on a particular theme, then I use that cash buffer to invest. So that's something, if you are investing for the long term, especially someone who is in 20s, who have time in their hand, they can think about having a long-term plan. At the same time, keeping a buffer for, any sudden market drops or you maybe having a strong views on some of the sectors.
Wow, that's a really good strategy, right? Yeah, to ensure that you still have like your solid fundamentals, but also a bit of leeway to kind of play with it so that, you don't miss out on the excitement when you want to. Okay. So in Chong, what is your investing strategy then?
Okay, my investing strategy, usually I have a 3 filter. So normally if I'm very interested in asset, I will look at the fundamentals first. Whether, for example, if I'm doing stock picking, the companies, how is their net profit margin growing? Is their revenue doing well? Whether any reputable fund is taking up them. So as long as the fundamental is okay, then I would have another filter whereby I have my own technical setup. But for most investors, if you are keen on technical setup, there's the 200-day moving average. So for that, you can see if price is above that, then the long-term trend is there. So technically, I have 2 filters. And the lastly is position sizing. Even though I'm keen on this asset, I normally don't go 100% on all in. So normally for an asset, I would only put 5% capital allocation. And if they continue to do well, I continue to stack up the position rather than entering one shot. Because what I learned is that if you put 100% allocation into a safe asset, it might be a dangerous move as well. So that's when I have 3 filters to ensure that I'm always in the right position to actually ease my whenever there's a dip, right, my emotional management is there as well.
Can you explain a bit about a safe asset? That's so interesting.
Okay, so just an example, if let's just say some people will feel that gold is doing well, and what if today this investor feel that this is the way, right, and he actually put 100% allocation on gold, and if let's just say gold happen to take a dip and a much deeper dip, can the investor really take it in terms of their emotion as well?
Okay.
So whenever I actually have a 5% allocation, that one, it will help me to manage my emotion. Yeah.
That's a really good point, actually. Yeah, because I think that's like last year, for example, when gold was on a quite strong rally, right? It's quite tempting to go all in, and then now we know like gold has gone down. So if that had been you, then you would just have your 100%, and then you will see it really drop. Yeah. Okay. That's a great point. And I think we have also heard of the term hype investing, right? And very timely because the SpaceX listing just happened. So, and we heard about how so many people went into it, became a record, right? Turned Elon Musk into like a trillionaire. So, I mean, what are your thoughts on hype investing? Have you actually seen like young investors in Singapore crowding into SpaceX?
No, I think that's a great point, and I'll say it goes hand in hand with the panic selling. When you see a lot of market movement, either you go to one extreme of selling something very fast, or you just end up chasing the next big thing, which is closer to hype investing. So my view is very simple. Something might be most popular, but may not be the most cheapest option out there. So when you are making a decision to purchase, don't just go with the popularity, but look at the actual price and whether it makes sense or not. Again, going back to my previous days, I remember there was this IPO for Groupon, which used to be a company to, for you to find out daily deals. It was an in thing. People were going crazy and everyone was just riding on the IPO wave. But within few months or I think years, it lost 95% of the value. So that's the reality. I mean, what might look attractive today may not be attractive few years down the line. So yeah, I mean that's a consideration people should always look at.
Right.
I think nowadays with social media, it has made investing more accessible. But at the same time, it can be a double-edged sword because they will be exposed to more market noises. I can really relate because I remember when I first stepped into investing back in the days that I invested, the first company is called New. Back then, there's a hype on EVs.
Yes, yeah.
So I just jumped onto a bandwagon and I bought it at a high. I bought it at $68. So if we now look, yesterday I just take a look at New. New is actually less than $10.
Oh, wow. Okay.
Yeah, so at that point in time, I was just jumping onto a bandwagon because a lot of people is buying it. So it made me reflect that as long as don't really go into the hype, you must really assess whether this asset is it worth buying and whether it can be hold for long term. Yeah. So depend on your plan as well. I think that if today, in relation to myself, when I first started investing as a young investor, I would also go into stock picking.
Yeah,
And
that's exciting, right?
It's exciting, the adrenaline, everything is there. But when I first get my first loss, that dropped 40%, that's when I start to go up the asset. Should I really look at stock picking or should I really go into funds? So if you really let me turn back the time, I will not go back to stock picking when I first started as an investor.
Right.
I will go into something more broader like S&P 500, whereby it's more diversified.
And in that way, you also won't be trying to time the market or buying the dip, right? Because, you are just like tracking the whole index.
Yeah.
And my view is also, I mean, in some of those scenarios, you can always keep some, I'll say, cash buffer aside. For example, if you feel that you still need to participate in the IPO, fine. But a good strategy here will be to cap the amount that you are putting in.
Right.
It should never be 100% of your net worth or closer to that.
Yeah, I think, that's such good advice. It definitely should not be 100% into like a new IPO, right? Okay, and I think, because there are young investors who are so interested in like timing the market, in trying to be savvy, right? In buying low, sell high, that's everybody's dream. But there are people who like don't work in finance or they don't work in asset management, not like you guys, right? They're not so in tune to it with their day-to-day life because they still like work their normal job, so they can't track the market that closely. So in that sense, like I guess timing the market is not ideal, right? So what other strategies should they consider then? I think you talked about buying funds, but are there other things that they could look into?
Yeah, I mean, it's a great point. And when we talk about investing, people always think about, working in a bank, or you need to have the right knowledge,
Yeah.
or if you need to follow the right news. But the reality is, investing is less about knowledge and more about discipline. And it's super important. I mean, if I go back to my earlier days, if I have the benefit of hindsight, I'll potentially start early. Especially if you are younger, I think time is your friend. Best way to get started is start small, especially in today's platform. It's so easy to fractionalize the stock. So what it means is you don't need to own a complete stock. You can just own a slice of stock for you to get started. If I take example of Meta stock, right now it's $600. So even if you don't have $600, you can still buy a stock today with, let's say, $50 or $100. So I think my advice and my view here is get in the market. Don't try to time the market, but try to spend more time in the market.
Right.
So if we are talking about people in their 20s, you usually have 20, 30 or 40 years in the market. And then over that period of time, maybe few dips here and there won't really make a difference.
Okay, yeah, that's a really good point, right? Like if you are in it and if you are riding it out for let's say 20 years, I mean, you won't even have remembered the COVID.
If you look at
dip.
S&P, I mean, over a 20 years of time, none of the peers have actually made a loss over the history. So, I mean, if you are able to spend more than 20 years, history suggests that you will always end up making money.
Okay, wow, okay, yeah. I mean, that's the best point of all, right? Like if you want to win in the market, just stay in it. Yeah. Okay, Chong, how about you?
Okay, I think for me is to really like what Arpit says, to really stay in the market. So when I first started, I'm really into like those fast wins, those adrenaline. But when I spend more time in the market, then I realized that sometimes the it can be very boring. But when it's boring, right, you are actually making more money than when you are like very hyped up and all the adrenaline. But then when I look back, I'm actually losing more money than when I'm just spending more time staying, not doing anything. Like very boring to me.
Actually, yeah, that's super interesting because people always say, when the market goes up, goes down, oh, that's the time I should do something, right? Because this is how I can finally make money. I can be like Warren Buffett or whatever. But actually, it's interesting to know that when nothing is happening, that your money is growing.
Yeah.
So I guess after we've talked all about like timing the market, buying the dip and all that, is investing really just about managing your emotions? It's not really about being savvy in where to put your money, when to put your money, but it's about managing your own emotions when you invest.
No, that's quite true. And I mean, I always say this: you never lose a money on a bad stock. You lose money when you buy stock when you're calm and when you're trying to sell it when you're scared. And it's all about emotions. The investing decision should always be done in a, I'll say, thoughtful manner. And that's where you need to take out your emotions from your investing process. We talked about dollar cost averaging, and it's a great way for you to put in a process where you don't need to worry about short-term fluctuations or noise in the market.
Okay, yeah. Do you think that too? Like investing is really, actually it's not about money, it's just about emotions.
I fully agree with what Arpit say. So investing is really having a disciplined plan. What's your risk allocation, and it's always okay to have a cash position because cash position, most of people is they feel that it's not exciting. But when the time is that when most people is scared, you can actually use the cash position as a leverage to buy more future opportunities. And your risk allocation based on risk profile and your time horizon. So anytime when the investor feels scared, afraid, or the negative emotion, right, that's when they take a step back, zoom out, and look at this plan to actually keep them grounded on their grand plan rather than just focus on a short-term plan. Because instant gratification always will get them into more trouble than just staying put, feeling the boringness of the market. Then you will make more money.
Do you think it's also good for young investors to just like maybe write down their investment goals or just have some investment goals that aren't just, making money, right? Because like maybe if they're like, oh, I'm saving towards a house or I'm growing my money towards retirement or something, then it will help them to stay invested and stay for the long term rather than just pulling out when the market dips.
Yeah, this question is very good because like most of the time, right, when we are too invested short term, we forget our long term goal. So let's just say today young investor, they are saving for their BTO.
Yeah.
Then whenever they are invested in an asset, would this one help? Would this asset help them to reach their goal faster or slower? Or like at this point in time, whatever they invested in, is it worth to take a risk? So based on this scenario, right, they will make better decision. Hey, what's the position sizing? What kind of asset should I be looking at? Or should I be looking at a more riskier asset, for example? So the time horizon of their goal actually will determine what kind of plan they should be having.
Yeah, I guess that's a great point, right? Because if your goal is for something, for example, retirement, that's like 20, 30 years, then you wouldn't be so worried about, let's say, the market dip last week, right? You wouldn't panic so much and you won't try to do anything because of that.
Exactly. Yeah, I mean, and you mentioned a great point about writing the goals. Writing actually forces you to think about what you actually want to do with your money. And then once you have that in place, I think executing that, to be honest, is relatively simple now with the kind of tools you have in the market.
Okay, yeah, so that's super interesting. So, I mean, I think our convo started with like, buying the dip, how are we going to do it? And then it actually went to the fact that maybe you shouldn't buy the dip. Maybe you should just always stay invested, right? Instead of trying to time the market and go in when it's low and then try to sell when it's high. Okay, so that's a wrap for this episode of Head Start on Record. Thank you, Chong.
Thank you so much for having me.
And thank you, Arpit.
Thank you for having me today.
It's been a pleasure to have you on. I'm Suetan. You can email us your thoughts on this issue or suggest another topic you'd like us to tackle on the show. And you can reach out to me on LinkedIn. And if you'd like to read my articles or Head Start's newsletter, all our links are in our podcast show notes. This episode is edited by Amirul Karim. Thanks for listening.